the world of carbon credits. It brings together government policy, industry, and now it's also investable.
So you're creating this economic incentive. And on the other side, the government's auctioning these credits and making a revenue. So this is by no means an unusual niche thing that you don't need to care about. It's $1 trillion asset class. It's the Bitcoin theory that there are less of these credits and there will always be less and less of these credits over time.
Welcome to this podcast where we're diving into one of the most interesting, fascinating, and topical asset classes out there, the world of carbon credits. It brings together government policy, industry, and now it's also investable. So, what better than to bring in an expert in the field, Luke Oliver, today. Welcome to break us down what drives pricing and how do investors get involved in this space? Thank you for coming in.
Thank you. Yeah, looking forward to it.
So Luke Oliver is currently the Managing Director, Head of Climate Investment and Head of Strategy at KraneShares. And prior to that, he built and ran the US X-Trackers ETF business at DWS. So we are in excellent company today.
Yeah, thanks for having me on.
So yeah, I guess just an intro for everybody. I mean, I started trading in carbon credits back in 2019 when I was at Macquarie, but that was very much the professionals that were getting involved. Hedge funds were clambering for exposure. But now it's available to people, in ETF form. Yes. But what are they actually investing into? What's the background?
Yes, and it's interesting you say that because we've seen so many, it's almost moving, started at the top of the food chain, the big banks, big hedge funds. We're now seeing institutional investors and family offices getting into this space. And now with the ETFs, it's open to everybody. And so what are you investing in? Well, what you're investing in is the global carbon markets. And when people say carbon markets, I would say 90% of headlines that talk about carbon markets are actually talking about something slightly different, which is they're talking about forest projects, they're talking about carbon capture. And these things are very important, very interesting, but they're not quite as investable because different forestry projects there's thousands of different projects, they're all different, and the people buying those carbon credits from those projects are doing so because they have made commitments, green commitments and things like that. That's lovely, that's great, it's interesting, but its total years trading is less than $2 billion. So that's the small end of the wedge. And because they're all different, and there's a lot going on there, it's not investable, it's based on a voluntary commitment. So let's put all of that aside. So I want to quickly draw a line under that. What we are investing in, and which these institutions that you're talking about are investing in, is the cap and trade programs of various governments, such as the European government, the UK government, the government of California, which is itself the 7th largest economy in the world, the northeast of the US, so think New York, New Jersey, Massachusetts, and states like that, as well as the state of Washington. Those are the big 5 that we have in the fund. But there's also New Zealand, Australia, China, South Korea, all have these markets. There's about 70 of these growing markets around the world. So what are they? It is a system to basically incentivize through a price mechanism, not through tariffs, not through telling people what to do. The governments are simply saying, we are going to issue permits on the number of tons of pollutions that the economy can emit. And the companies within those economies have to trade and auction and bid against each other for these credits. So all that does, and I should note, this price isn't overly inflationary. It's not a price that shuts down businesses. What it does is create a friction point that allows companies to start to optimize like they do for everything else. How many people do you hire? How many factories do you need? How many offices do you need? Now companies are saying, can we be more efficient on the amount of pollution we create? So you're creating this economic incentive. And on the other side, the government's auctioning these credits and making a revenue that they can plow back into the economy and back into some initiatives on the more sustainable side. So you've got something, and of course the key to this is that they engineer the price in the same way the Fed tightens rates. They are tightening the supply of these credits to engineer the price higher over time. So we get to be long. And in fact, as financial players, it's our job in the economy to create price discovery, and we get paid to create price discovery. So we should be buying these credits that companies are going to need over the next 10 years to sell back to them at prevailing market rates. So a lot there.
And when did this idea first come to fruition? Was it and where?
Yeah, well, if we go, I mean, this is almost like the birth of a futures contract. Whether it's the futures contracts on tulips, going back some hundreds of years ago. But more recently, and very specifically in terms of sort of environmental credits, think about the fact that acid rain. I don't know, you guys might be a little younger than me, but when I was a kid, acid rain was going to destroy the earth. They created a cap and trade program for acid rain. And they put a price on the pollution that caused acid rain, and they auctioned credits. And they found that for every dollar that was spent on the credit, there were $3 spent on solving the problem. And this problem was solved. In about 10 years, we don't have acid rain anymore because they put a price. And by putting a price instead of, say, a tax, if you banned that chemical, then you would kill industry. Instead, you put a graduating price on that pollution, and companies say, okay, well, this year we're still polluting, unfortunately, but next year we can start to put filters in, we can start scrubbing our output, and they solve the problem over time while monetizing it with these credits. So that's where it came from.
Got to be the Europeans that started it.
But the Europeans, so the Americans did the cap and trade for the acid rain. But of course, when it comes to carbon and methane, multitudes bigger problem. Europe was the leader. So Europe came in and created the first carbon cap and trade program. And this was around 2007. And so it's not an ancient market, but it's also not a new market. This market's been around a long time. And here's the key. It's traded last year between the auctions, secondary market, and the futures, about $1 trillion of volume. So this is by no means an unusual niche thing that you don't need to care about. It's $1 trillion asset class.
So would you say that that's the reason why now is such an opportune time to get into this area?
It's part of it. It's what makes that liquidity allows it to be accessible and to be an allocation in every portfolio. But the timeliness now is that about 2 years ago, we hit an inflection point where the number of credits being put into the market started to be insufficient for the amount of credits that were needed by the market. Prior to that, they were quite generous with the credits, and that kept prices low.
Let's just go through the government, because they wanted to make it very transparent on how they were going to do it, didn't they?
So they start off by, so the way that the mechanism works is, let's say the European Union wants to reduce its emissions by 40% by 2030. So they will look at what their emissions are today. They'll look at their benchmark, which was 1990 levels, and they'll say, let's sell that many credits and a little extra, because that will allow them to be readily available. They will be inexpensive, and companies, if they're clever, can buy extra to hedge towards the future. So that's how they start. And then over time, they reduce the amount. And then over time,
by a fixed amount per year.
Fixed amount per year, but a little bit, it can be sort of dynamic. So they have made policy, we can model it going out to 2050, but they may accelerate that, they may decelerate that, but that's where we watch policy. So some people say, oh, so you've got to watch the policy, that's unusual. And I said, well, you have to watch Fed policy for everything else. So it's not that unusual. So there's precedence for that. But then they reduce this, and so a couple of years ago, and so they reduce it to the target. So by 2030 and 2040 and 2050, there will only be a limited number of credits. So you can still pollute if you want, you can still do everything you want, but be prepared to pay a lot for that increasingly scarce permit. And
let's build that picture for the viewers and the listeners. So I'm a big, ugly coal factory, right? And I'm sending my coal to the steel factory next door.
Yep.
Right? The world's worst nightmare at the moment. And then along comes our friend, the wind farm, and with his solar panels. Who gets credits to start with? Who has to buy them? Who sells them?
You will both potentially be in the market that you both need to buy them. But he won't have to buy many. Maybe he doesn't have to buy any. And he's producing power. Now, maybe the windmill is more expensive than burning coal. but he doesn't have to buy any carbon credits. And there's actually another guy that sits in between you, is the power station that's burning gas. So it's dirtier than the windmill, but it's cleaner than the coal. Right. And right now, people are saying, well, what's the cheapest? As much as I want to save the planet, I also want the cheapest electricity, and it's coming from this guy that burns coal. Yeah. So they're buying your power. What will happen is this price of carbon starts to be engineered and starts to rise. So for every unit of power, you're going to buy 2 carbon credits. This guy's going to buy 1, and you're going to buy none. So as that price goes higher, it starts to make your business less profitable. Yeah. Or you pass it on to the consumer, and your power gets more expensive. So the consumers start to say, I might buy this power now. Or you say, well, listen, I'm a nimble, smart company. I'm actually going to convert all my boilers to burn gas instead of coal. To save money. So you start switching to gas, and suddenly you start becoming cheaper again and more competitive. So I start saying, I'll buy your power again. So it's not about putting you out of business and giving him a job. All of these people can survive, but by having this price on carbon, either the customer will switch away from the dirty to the clean, or the dirty will clean up their act. It's your choice.
And are we actually seeing that? Because it's been around for 18 years, and the price, we had a huge rally in 2021, and then it's come back off. Why has it been allowed to come back off? Why?
Yeah, well, so 2 things. To go back to the first part of the question was, the price had a great year in 2021. And that's because we had this inflection point where the amount of credits being auctioned were suddenly, or moving into the territory of not being enough for how much was being polluted. And so people went from building hedges and being comfortable with the supply to realizing that the supply might not be there in the future. And so suddenly the coal guy and the gas guy started saying, let's get make sure we have enough credits. And so that's when we saw that acceleration in prices. And also the financial players like us and your investors and many of our clients said, this is undervalued. We can see the demand and supply model, and we publish this every month or so, we update our demand and supply models, and we can show how tight this market's getting. And it's not very difficult to then discount back that future tightness and realize they're undervalued. So people started getting long. So the price did accelerate, and we saw this big acceleration of switches from coal to gas. Now, this is where I paused a second ago. There's 2 points. The energy companies, so RWE, one of Europe's biggest energy companies, they are very clever, very sophisticated. They hedged themselves to this years earlier at 18 euros. The current price is 70 euros, 70. So they've made a lot of money on that hedge. And so if some people say, well, that's kind of broken then because they'll keep polluting because they're hedged. They don't care about the price of carbon. But that's not true, because if they keep polluting, they're going to just have to use them. Yeah. And that's like selling them again at 18 euros. Yeah. Whereas if they reduce their emissions, they're going to be able to sell them for 69, 70 euros. So the mechanism is very elegant in that it works. Whether you're hedged or not, you are incentivized to become more efficient with your pollution. So that's why it works. Now, your next part of the question was, why has it come off, or why was it allowed to come off? Well, something huge happened, which was the invasion of Ukraine. And if we remember how much of the supply of natural gas into Europe comes from Russia into Germany and elsewhere. And so the lowest hanging fruit that caused the price to rally was carbon was rallying and people were getting rid of coal and switching to gas. Right. And suddenly gas is no longer cheap anymore, and gas prices went up 400% with the invasion, and the pipelines were cut. And so that exacerbated the European economy because people couldn't just go back to coal. They just couldn't operate certain businesses in chemicals and metals. And so as a result, the economy started getting crushed. And if you're not doing any business, you're not doing any pollution. And so the demand for credits started to pull back. And then the European Union realized that carbon credits at 100 euros when the economy's struggling is going to be a challenge. And so what they did, it was very clever, but a little overplayed. They said, we're going to bring forward some of the auctions in the future into the front. So they sort of increased supply in the short term. So they did that for 3 years, followed by 3 years of extra tightening to cancel it out. So
Which takes us up to
now. So we had 2 years. So 2022 was the invasion. We had 2023 and 2024 and 2025 of still tightening, but less tightening. And that's why we've had soft markets. So you can see where we're going.
I like this story. Now you're building up this story.
We're building into
you get a ceasefire, you get peace in Ukraine, gas flows back into Europe.
You get the demand.
And you've got a tightening.
Yes. So
Okay, I'm in.
Right. So even without the ceasefire, we've already got sort of stabilizing gas prices. They're still volatile, but this cliff event where we've had this extra supply and then we go back to tightening and accelerated tightening because it's making up for the 3 easier years. So we are about 9 months or so out from this event where the market starts to realize it's tightening up rapidly.
It sounds like it's the inverse of quantitative easing going to quantitative tightening. You've essentially got tightening going to easing.
Yes.
With the effect of
exactly.
the price.
It's sort of the reverse system, but the analogy is right that we are going from relative ease to relative tightening, and tightening means higher prices. And so we are coming in. So this is why when you asked the question at the beginning, why is this an interesting time right now? Well, we had California carbon, which we haven't even touched on, was up 30% just over a year ago, and Europe was up over 100% back in 2020, 2021. We've had a do-over on that because these prices have pulled back. California pulled back for another reason, and I can touch on that. But Europe pulled back because of this Ukraine invasion and this disruption to natural gas and the policy they put in place for that. So as we exit that policy, we should see prices looking like they were potentially in 2021.
And then you've got 500 billion euros of German infrastructure spend.
Yes.
Which is going to take
industry. This is going to take industry up a level. Yeah. And sadly, and this is interesting because this investment, the price of carbon, is one of the most impactful things you can do. But you shouldn't invest in this just because you want to do something nice. The portfolio characteristics themselves speak for themselves. And so this 500 million of spending might actually increase pollution. So that's not an ideal situation from a climate or environmental perspective. But for a demand in a tightening supply of carbon credits, it's a very positive sign for carbon prices. So that's like a third catalyst, ceasefire, stabilization of gas prices, policy ledge coming up, and then increased industrial activity.
The main way that obviously investors can get access to this is through the KRBN ETF, which is the KraneShares product that we have on our platform. Coming from sort of a portfolio management perspective, and many of our clients who are on our share dealing platform build long-term portfolios of equities, bonds, and ETFs which contain those. How would you say that this particular ETF, KRBN, would fit in that, and how does it sort of correlate with equities and bonds?
Well, and this is another interesting one because I sometimes sort of half jokingly say, if I describe a portfolio component, do you like it or not? And if I said this is something that has had and we think could maintain double US equity-like returns, double the vol, so the Sharp is comparable to US large cap equities, which has been the best thing you could have held forever. Similar Sharp, but the correlation's only 0.3. I think right now it's at 0.29, going back to 2014. So similar Sharp, very, very low correlation.
And it doesn't move in the same direction.
Doesn't move in the same direction at the same time, but yet has this high return profile. And so if you told any portfolio manager that, they would say, of course, I would like that. That's the perfect alternative. Something with low correlations, but with the same sort of risk-return profile. So for that reason, this is just a classic alternative investment. If you have equities and bonds, this is a perfect addition to that. If I take that one step further, some people say, well, what do I sell what do I replace this with? Well, you could just make room for it between your equities and bonds if that's what your portfolio is made up of. Another thing to look at, though, is commodities. Commodities people like because they are a diversifier, they are inflation linked, and they do kind of work as an inflation hedge. But there's no real expected return in commodities. The idea is that if demand outstrips supply, they rise. That's why they help with inflation. But over time, inflation-adjusted commodities kind of tread water, whereas carbon has the two benefits of commodities, but they're designed to rise in real terms, meaning more than inflation. And so you've got something that is actually additive, and commodities can be expensive to hold, whereas carbon isn't.
Explain that. Sorry, the correlation to inflation.
So commodities generally correlate with inflation or an inflation hedge. Carbon is designed to rise in real terms. If it only rose with inflation, it wouldn't really be rising, and it wouldn't be having the catalyst.
And that's with the drop in the yearly
supply.
annual.
Yeah. So think about commodities. If the price of oil goes up, they pump more oil to sell at those prices, and then the price of oil comes back down. With carbon, no one is pumping more carbon credits into the market. Even in Europe during the Ukraine, to sell more, they had to borrow from the future, and then they're going to pull back out.
So it's Bitcoin theory.
It's so great. I love that you say that. That part does sound. It's the Bitcoin theory that there are less of these credits, and there will always be less and less of these credits over time. Where it's different, and I definitely don't want to get into a Bitcoin argument, but these have an intrinsic value, whereas arguably Bitcoin doesn't. Now, we know that Bitcoin's almost too big to fail, and it's faked it till it's made it, and it is a store of value, sort of. But carbon credits, there is a company, whether it's an oil company, a cement, steel, you name it, car company, shipping company, that needs to buy these. And they look at their costs, they look at their margin, they look at the cost of doing business, and they have a budget that they must buy these credits. So there is a backstop, that there is an economic value to these credits. So to me, it beats Bitcoin in that sense.
Did the European Union realize how much they were screwing the market over by changing the goalposts? Because suddenly I don't believe in it, because every time it goes up, the European Union changed the goalposts.
They can move the goalposts. So it's interesting. They considered lots of ways to navigate this Ukraine invasion. And that's a pretty unprecedented event. And so I give them credit for having to deal with that. The way they dealt with it was probably the smartest, best way they could deal with it. The problem is they did 3 years, borrowing from 3 years in the future. They probably should have done 18 months. But in the depths of 2022, this didn't feel like something that was going to be over. It's still not over. But so what they did is very clever, because they could have increased the cap. And I think that would have made people say, well, that's moving the goalpost too much. They could have sold some of the stability reserve, which is a reserve of credits that they use for extreme predetermined outcomes. So adding another predetermined outcome would have seemed like moving the goalpost. So what they did was the least moving of the goalposts they could do, which is saying, we will add some credits, but we'll take them out of tomorrow. And so it was the best thing they could have done. And it was very elegant. I just think they were a little heavy-handed with it. But it does give us a do-over in terms of prices. If you're coming to this market today, you get to be back in 2021.
Have the bad players just loaded up and they're sitting with a whole load of carbon credits on their balance sheet now? Where's the demand come from in January? Yeah,
well, I'd argue, I try not to say the bad players, because it might be someone burning a load of coal, which is bad for the environment, but they're also providing us with electricity for all the lights and cameras. So I try to be agnostic on good and bad. Sure. This is just an ingredient into the economy. And so, so the companies that need to buy these credits have started to load up on them at these prices. So in Europe, I think there's a natural floor type price where if they get down to 65 euros, companies are just going to buy as many as they can. And that's why today we're about 69, 70 euros. Just to give you some context, the range pre-Ukraine was about 80 to 100. So that 70, I think, gets back to around 90 in the next 18 months. And then longer term, this could get to 160 euros a ton. And then I'd love to talk a little bit about California, because...
Sorry, what weighting is Europe then?
Europe's by far the biggest market. It's probably 70+% of global volume. We're about 60. We are 60% in our fund.
Okay.
So KRBN is 60% Europe, 25% California, and then 5% each Washington, UK, and Reggie. So Europe's definitely the dominant player. You definitely want it to be the dominant allocation in your portfolio, but there's so much value in having this global portfolio because there's some really juicy additions you get from those other markets.
Are you using swaps to buy these, or is it a physical backing inside the ETF?
Interestingly, we do what I think is the optimal way to address this. So we don't use swaps because the swaps tend to be a swap on the futures, meaning you're paying a bank to replicate the futures for you. So you're paying another layer of fees to someone to help you do something in the futures market.
Like that.
No, we want low fees or lowest fees possible. On the other end of the spectrum, getting physical is possible, but they're not very liquid. And often moving in and out of the physical means the physical themselves aren't liquid, but you're using futures to get in and out of them. So there's sort of another layer of cost to now, you think physical sounds like there's less costs, but you're having to work your way into it with futures. And what we do then is we just manage the futures directly. So it's a bit of the best of both worlds. We have all the liquidity, all the price discovery is in the futures, and we manage the futures, so there's not an additional cost. There's not a fund cost and a swap cost. But I will say one interesting thing is, again, why I think there's sometimes a misconception around futures, that futures, if you're buying a 1-year future, it's more expensive than the spot. So are you paying a premium that is costing you money? Well, a future, just by its design, is a leverage vehicle. So you're charged a borrowing rate to get that leverage. It's just implicitly how futures work. But that relates to the cost of capital. We aren't levered. So if we put $100, if you give us 100 euros or dollars into the fund, we put on the futures. That futures has a bit of a premium because of the cost of capital, but we don't need to borrow. So with the remaining capital, we buy ultra short duration, ultra high quality bonds and earn back that yield. So we actually net that out. And so it's sub 1% is what's baked into that futures curve, the net. And so don't let anyone tell you that there's a 5 or 6%.
I was going to say, as an ETF provider, I'm sure there's some out there that may be tempted to keep that for themselves.
Well, they could, but then for us, it's like it's essentially we package. I mean, how an institution would approach this. We want this fund to be for retail and institutions, and that's who we have in the fund. If you tried to pocket the yield on the collateral, I think you'd have a problem. The institutions are going to see. I mean, we wouldn't do that in any scenario. But in the way we think about it is, we are packaging you the exposure to carbon, and the fact that we use futures to do it. If we can earn you back any expense related to the forward curve, we're going to do that, and that's how we're able to be very efficient with the futures.
Yeah, absolutely. I guess it's probably important to talk about to an extent, the elephant in the room. Obviously, we've got a new president who's been there for a couple of months, and he's not the biggest fan of ESG, and he's not the most positive on climate change. How does that fit your sort of view on things?
Yes. Well, so carbon, and this has always been our approach when we talk about carbon. We've never said, hey, this is an ESG fund, you should buy because it's an ESG fund. There's no doubt this is one of the most impactful things you can do towards solving climate change. In fact, most economists will tell you this is the only thing that will work. But at the same time, it is a market mechanism. It has demand and supply dynamics, and it is structurally designed to give you an asymmetric upside. The downside is supported and the upside is opened up. And so I don't get too bogged down in defending it as an ESG or a not ESG. It's an alternative investment with its own fundamentals. But to your point on Donald Trump, so take California's program. It's been challenged before. It was challenged in 2017 during Trump's first presidency. It was challenged by the Chamber of Commerce of California, and they had to get very creative on finding ways to try and challenge the legality of this program, and both failed. Program's still there. Program's in very good shape, and so federal government cannot tell a state it can't run one of these programs. In fact, the state of New York is building its program. The state of Washington just launched its program. And in this same election, they put it on the ballot. Do you want to keep this program or not? And the state of Washington voted to keep this program. And so they're well supported by the individual states. So we're not concerned from that perspective. We have seen that the lawmaking and the tightening measures, maybe they're a little more cautious about implementing it because they don't want to draw any attention or criticism on that side of things. But we're not too worried about that. And this is where California really stands out because it has an explicit 5% plus inflation. So if inflation's 3%, every year their floor price and their ceiling price increase by 8%. And so you have a scenario today where European carbon trades at $30 a ton. The floor is only 26, but the ceiling is 94.
And so how does the ceiling and...
Yeah, so they auction these credits every 3 months, but the auction will not clear if the price being bid is below this floor. So if the spot market trades below the floor, people are going to buy in the spot market and they're not going to worry about the auction. The problem is if the auctions don't clear, then there's no more supply coming to market. And so then that accelerates the tightness and the price then rises. So there's this it acts like a soft floor, but the price basically can't stay below that level. And so we've seen it dip once below in 2019 and then pop straight back up again. And so that's how the floor price
This is
works.
when we were trading it. That's why the hedge fund came on to Macquarie and said, right, we want to buy it because it was through the floor. And it went down another 3 or 4%. Yep. And they said, we don't
just
understand
can't
this.
Stay here. Yeah.
Buy us more.
Yeah.
And so they bought another $10 million worth.
Yes.
And it worked.
Yeah.
So you said that California's come off and we might sort of have a look at that because it is a significant part of the fund. So yeah, what's the setup in California?
So this is our second biggest holding, and I spend 98% of my time talking about Europe and California. Yeah. And so we talked about Europe and why that's so well positioned. California is so well positioned because we're quite near that floor now. And when back in 2019, these markets were much thinner. The California market trades $60-70 billion a year now. There's not the inefficiency for it to drop below the floor and people not jump on that. Now everyone's doing that trade that you guys are doing. And so it does, that floor is going to be quite firm. So $30, your downside is down to 26, but your upside is potentially up to 94. But that 94 is going up by 8% a year also. So where we are with California is two drivers or three drivers. First one is we've got another one of these kind of policy cliffs where we're seeing the price, the supply in California goes from a growing surplus to a shrinking surplus starting next year or 2027. So we're about a year and a half from that cliff. Secondly, we've got the fact that we're waiting on policy from California. So we're waiting to see that they're going to tighten from 40 to 48%. We're waiting to see what trajectory they're going to build in. But essentially, they are accelerating the tightening of this market. And the reason we've sold off and had a sort of do-over on the price is because they pushed back the implementation by a year. And that sort of shook the market a little bit. And the market said, no one said we're out. They said, we're going to come back in 6 to 9 months when the policy is closer to being made, because Bitcoin was rallying, the S&P was rallying, Nvidia was rallying. There were other things you could do with your money. But as soon as we get close to this California policy implementation, people are going to surge into this space. And then there's one other catalyst, which is really important, is this surplus gets very tight by 2031, 2032. So when that happens, the market is going to have to move to one of the upper tiers rather than the floor, where at the higher tiers, they sell extra credits. So there's this potential.
So there's a fund that they can tap.
They have, yes. So there's a ceiling, and then there's 2 layers below that where they'll sell extra credits. So as soon as you have the policy clarity and you can model when the surplus runs out, then you know that it's going to have to trade at least at one of these tiers, and then you discount that tier price back to today, And the punchline here is that it's trading at 30. That first tier is at 60 right now, and next year will be 66 or so, or 64. And
that's 2031.
2031. Well, no, 2031 it'll be in the 80s. But once that is identified, then you can discount that back to today and the intrinsic. Essentially, what you can buy today at $30, once we have policy clarity, will have an intrinsic value of about 65 in the next year or so. And then it should trend up to that 80 number. And in fact, the California Air Resource Board, who govern this body, this program, they actually put a number of $134 by 2030. So what I'm talking about is more a base case rather than the bull case.
Unfortunately, we have to cover it because we're talking about California. Did the fires affect the program?
Not directly. And not really is the short answer. One end of the spectrum, it highlights the action that needs to happen. And so from one side, people have doubled down on it. The question I get a lot is, because the group, the California Air Resource Board that manage the program, also have some responsibilities as it comes to air quality and the recovery effort, will they be sidetracked from making policy if they're having to deal with the fires? And the answer is the division that goes out on the street and does the work is different to the division that manages the policy. So we don't expect it to be negative in any way. If anything, it puts more impetus on taking the right action.
And the other one that unfortunately we have to talk about because black swan events are not fun to be part of, the San Andreas fault. What happens if the big one happens?
Oh, that, God, I haven't had that one before. But what would happen? I mean, there's so many loops to go through in my mind. But I mean,
you'd be happy it's only 25% exposure.
Well, yeah, and where I'm going with that is that, but that's like, what if there's a nuclear war, or what if there's a million things that could happen that are total black swan events, and as we know, by definition, they happen more than they should. But even though we have this great risk return number and we have this great correlation, there are things that can happen that are bad for stocks. I mean, what would the big one do to stocks that would wipe out, a lot of the California economy? So it's not like, oh, don't, this thing is exposed to it. Everything's exposed to that. Yes, and so my point is, there's no perfect investment that goes up when things go down. The low correlation, proven statistic, very appealing. But yeah, if you had a complete destruction of the economy, that would be bad for stocks. It would also be bad for carbon because there'd be no pollution. So yeah, it's
construction
a really
companies outside California.
Well, who knows? So that goes back to your fire point. If they start rebuilding all these houses, that's going to cause more pollution than they had previously modeled for. So that might actually be good for carbon. But I also want to be careful not to.
It would be a tricky
bag on people losing their homes, but that might be a side effect of this.
Yeah, I think that wraps up today's webinar. It's been a really, really inspiring and interesting content today.
Something different, I hope.
Absolutely. It's shown that there's all sorts of different vehicles you can access on our platform, not just your standard stock and bond ETFs, which can, these sort of ETFs such as the KraneShares carbon product can add potential diversification to your portfolios.
Now, where do investors find it? What's the ticker?
Well, KRBN is the ticker, and KRBP is the sterling pound line. So both of those trade on the London Stock Exchange. We also have the KRBN line in the euros in Italy and Germany. And then in the US, I'm not sure if it's accessible on the platform, we have KRBN. We also have KCCA and KEUA, which are the Europe and California, respectively. But KRBN, that's the global basket that we've been talking about.
There's somebody in the UK that wants to not pay the FX charge, it would be PB.
Correct, KRBP.
BP, of course. Excellent. Luke, thanks so much for joining us.
Thank you.
And thank you very much, Quizmaster.
Thank you.
Question Master.
Thank you both.
Join us again next time for a look into alternative asset classes, and we break down the complex products that are available on the IG platform. Thank you.